Ramsey Solutions crunched the numbers and determined that a 50-year fixed rate mortgage would lower monthly payments, but overall, a person would be paying a larger grand total because of the higher interest rate. So, for example, if you took out a 50-year mortgage for $200,000 at a 6% interest rate, your monthly principal and interest payments would be just over $1,000. However, the interest that you would pay during the lifespan of the loan would exceed $430,000. If you took out a 15-year mortgage for $200,000 at a 4.5% rate, your monthly principal and interest payments would be around $1,500. Even though it is a little more cash up front, the interest that you would pay over the life of that loan would be around $100,000. That is $330,000 less than a 50-year mortgage. So a lot to take into account here. I'd like to bring in mortgage advisor and host of the Rate Update, Mr. Dan Frio. Dan, great to see you. All right, this really has a lot of people talking in the newsroom today. What was your initial reaction to the prospect of a 50-year mortgage?
Well, first off, thanks, Nicole, for reaching out to me to actually address this. The first thing you would think of if you're a home buyer, because this is going to affect the home buyers mostly, you're thinking, okay, this is fantastic news. It's going to plummet my payments. But when you really dive into it, is it really helping you or going to hurt you? Here's my thoughts on it. Like you just said, the overall payments are going to be at least double what you're going to pay. So what a lot of people are looking at is when you get into that house, I want some major relief. And if you do break down the numbers, the difference in a 30-year mortgage versus a 50-year mortgage, in your equation there, you're using a rate at 6%. But what is going to be the 50-year mortgage rate? Right. Because a 15-year mortgage rate is lower than a 20, which is lower than a 30. So what's the 15 or 50-year going to be? So that's one piece of the puzzle. But overall, I think this is more of a payment relief tool, possibly for first-time home buyers, mainly because a savings of $150, $200 isn't really fixing the problem. So that's what, is this a ploy to get more and more people into the housing? I think it's more of you're going to pay a lot of money over time. So, the caption you had earlier, is this a relief for home buyers, or is it basically a wealth building crasher for people out there? That's going to be dependent on where you live. Absolutely. And as you said, it really does depend on that mortgage rate because, right, you would think if it's 50 years that interest rate would actually be lower. But again, you're paying that every month for 50 years. Yeah, that's a long time. And you would think, okay, going from a 30-year to a 50, what's the first thing you would think of is what? That payment's going to really plummet. It doesn't go down. It goes down 8%. 8.44% is actually how much it drops. So there's not that big a relief. I mean, unless you're buying $1 million home. So if you're buying an average house today, $300,000 or so, it's going to save you maybe $150. Now, $150, but then when you add the taxes on it, then the insurance that's going up 27% a year and so forth, it's a struggle right now to buy a house. And that's why I love the caption that you guys had. Is this going to help or really hurt the markets? And then you think if your payments go down, this is going to push more people from renting to buying. So then ultimately what's going to happen with the home prices? Right. They're probably going to go up as well. So you have home prices going up, taxes going up, insurance going up. So in the long run, I think it might just be a ploy to get more and more people in there because the savings really doesn't add up when it comes to the payment. And you mentioned the fact, there is this 15-year mortgage. There was the 30-year mortgage. Has anything like this ever been tried before, a 50-year mortgage? So here's the problem: is I've been doing these numbers for years. And the Dodd-Frank bill that came in during the housing crash of 2008, there was legislation that passed that allowed a 40-year mortgage. So then when that was passed, we're thinking, okay, can things really change to a 40-year mortgage? And then when you start doing the numbers, it's like, okay, it doesn't save you as much as you think. So one part of the legislation is the max term right now is 40 years. To get a 50-year cycle out there, you're going to have to change the legislation, which is going to act. I think I did the numbers. I think there's a 30 or 40% chance of that really passing. So I don't think this is really going to pass. But if it does, again, I would still, if you're looking to buy a house, I would look to make it affordable in a 30-year term. And if you can't make it work, then, just try your best to save, do what you can, and just get into that. Because, could this help? It's like that old adage. It's better to be, don't time the market. It's time in the market. So could this get some people into housing? Yeah, it could, but it's going to take you over 20 years to pay down and get $50,000 in equity in your house. That's a long time to build equity, but it does get you into the market. So it depends on where you are, what your situation is, and what rent looks like in your area as well. So like I always say, it's what your area is doing, what your market's doing, because every market's a little bit different.
And last question for you, Dan. I mean, if this becomes a reality, this 50-year mortgage, who do you think would be the ideal customer here? Because would people over the age of, like, say, 40 or even 30 potentially kind of be excluded, considering the average American lives to about the age of 78, which would be just shy of making those final payments if a 30-year-old took this type of loan? I mean, is this ideal for somebody in their 20s?
Yeah, I think, like I was saying earlier, I think it's a first-time home buyer get in, because many are struggling. You get out of college, you have that college debt. Then you probably need a vehicle. Then you need this, and then so it could help first-time home buyers. You know what, Dan?
I mean, let's be honest. There's a lot of first-time home buyers right now in their 30s and 40s who are trying to get in now.
I see them every day.
Yeah.
We got 5 contracts in today, and probably the average age is, like you were saying, 35 to 40 years old. It used to be, 26, 27-year-olds, and you're out there trying to educate them on the financing of this. But in today's market, it's completely different. And I have to admit, what I'm seeing in our markets and on the applications, there is a huge disparity with the haves and the have-nots. There truly is. So I come out each day, try to help those out there that are, down there to help educate them. Economics 101, how do you budget? Just things like that to help educate them, because once you buy that first house, it doesn't stop there. If you're a homeowner, you're going to buy furniture, you're going to buy this. A lot of people don't understand. You have a cable bill now. You have an electric bill. You have all these bills that you didn't have at home.
Just all of the things that you can't call the landlord. You have to pay for it yourself. Yeah, it can be very daunting.
I love home ownership. It was a dream of mine. I think it's still the American dream, hopefully. And so, that's why I do what I do on a daily basis, is just to help inform people of things just like this, and not to really force it down their throats, just to say, here's the reality of it, and here's the numbers.
Well, we will see if this 50-year mortgage becomes a reality or not. Dan Frio, thank you so much for your time.
Thanks, Nicole.